Hello MSc classmates, thank you for watching our presentation. Let us introduce our teammates. I see Wong, Neda, Sudong, and Tapriya. We came up with our team name of Asian Matadors as all of our group members are somewhere from Asia, and obviously we are all the system Matadors. Today we will be presenting audit and accounting in Japan. As our agenda, we mainly talk about overview of accounting profession in Japan, development of Japanese accounting standards, voluntary adoption of IFRS and development of conversion to IFRS and US GAAP, corporate governance structure, audit and disclosure requirements, Japanese business system, and recent fraud cases.
The first group of professional accountants in Japan is said to have emerged around 1907. However, it was not until the enactment of the CPA Act in July 1948 that the formal establishment of the profession came into existence. The CPA Act was designed to ensure professional standards compared with those in the US, to establish publicly recognized status for CPAs, and to respond to the growing post-war demand for the democratization of business following the dissolution of large conglomerates and the introduction of foreign capital. It was under the amended Security Exchange Law 1951 that the examination of corporate financial statements by CPA began. Nonetheless, no full-scope audits had been conducted until 1957. Following the amendment to the CPA Act in 1966, which allowed CPAs to set up audit corporations, the first audit corporation was founded in 1967. An audit corporation in Japan is similar to a partnership in Western countries in that all partners are jointly and severally liable for the firm liabilities without limitation. The amended CPA Act in 2003 created the concept designated partner to alleviate the legal burden of partners who are not engagement partners. Only designated partners who perform audits are jointly and severally liable for their misconduct and negligence. Enacted in 1948, the law provides the basic structure of the audit profession in Japan, strongly influenced by the U.S. Sarbanes-Oxley Act 2002. Considerable amendments to the CPA Act were made in 2003 and 2007 to strengthen the auditor independence rules and help prevent corporate fraudulent accounting. Originally formed in 1949 as a self-disciplinary association and reorganized under the CPA Act in 1966, JICPA is the sole professional accounting body in Japan. Members are legally required to comply with the JICPA Constitution, which includes provisions on member obligation to observe the Code of Ethics and other resolutions of various committees. Financial accounting standard for business enterprises is a major source of Japanese GAAP developed by the private organization Accounting Standard Board of Japan. Japanese Commercial Code provides general rules for preparation of financial reports, and the requirements cover the very important areas of accounting. Accounting Standard Committee reports issued by the Accounting Standard Committee of the JICPA. Tax law is also deemed an important source of the GAAP since tax provisions are used as accounting guidance in the areas where no accounting standard exists. Auditing standards were codified by the Business Accounting Council. The current auditing standards are basically similar to those applied in the United States, but there are certain differences, especially in reporting standards. Accounting in Japan is influenced by characteristics of the economy, legal and taxation system, culture, and providers of financing. The economy is dominated by a few conglomerates known as keiretsu, which focus on close business ties and reflect cultural value of collectivism. Traditionally, the main source of finance for business in Japan has been bank credit. Cross-ownership is also common among Japanese companies. The outside equity capital market has not been a major source of financing or a major influence in developing financial reporting standards in Japan. Corporates are seen more as funds available for dividends than as a measure of corporate performance. Government influences accounting via commercial code, corporate income tax law, and stock exchange law. Stock exchanges in Japan are government regulated rather than self-regulated. The stock exchange law is administered by the Ministry of Finance. In general, companies are not under pressure from their main finance providers to publicly disclose information, since providers tend to be close to them, and Japanese companies are normally reluctant to provide information voluntarily.
In this slide, I will first talk about the development of accounting standard. Accounting Standard Board of Japan is an independent and private sector entity that develops accounting standard in Japan. It has issued many accounting standard, guidelines, and other documents that address practical issues. Japanese GAAP is one of the standards issued by ASBJ in order to regulate financial reporting of public companies. In early 90s, the economy was prosperous and many Japanese companies developed international business and looked for an uniform accounting standard in preparing financial statements. Thereby, in August 2007, the Tokyo Agreement between the Accounting Standard Board of Japan and International Accounting Standard Board aims to eliminate major difference between Japanese GAAP and IFRS. The board sees the convergence of IFRS with Japanese GAAP as an important step on the path towards Japan's possible adoption of IFRS in 2012. However, Japan hasn't adopted IFRS due to the practical burden. Now we are looking into the comparison of IFRS and Japanese GAAP. The transition from Japanese GAAP to IFRS can be a long and complicated process with many technical issues and accounting challenges to consider, which including first, the consideration of data gaps. The IFRS may require the calculation or collection of information that was not previously required under Japanese GAAP. Secondly, the consolidation of additional entity. IFRS has different consolidation principles than those of Japanese GAAP. The difference may cause some companies to consolidate entities that were not consolidated under Japanese GAAP. Thirdly is the consideration of accounting policy. Some IFRS standard allows companies to choose between alternative policy, so companies should select carefully the accounting policy to be applied to the financial statement and have a full understanding of the implication to current and future periods. We have known that GAAP is a rule-based framework that is detailed and complete standard for financial reporting. While IFRS is a principle-based framework, it is different interpretation of similar transactions, and it could lead to extensive disclosure in the financial statement. In addition, IFRS and Japanese GAAP exist difference in terms of their methodology used to assess an accounting treatment. The research under GAAP is more focused on the literature, while under IFRS, the review of the facts pattern is more thorough. We also compare the difference by listing some items that have different accounting treatments in preparing financial statements. For example, the goodwill under Japanese GAAP is amortized and capitalized. However, under IFRS and US GAAP, the goodwill is capitalized but not amortized. Now I will talk about the factors that affect financial reporting. The first one is the business environment. Business companies in Japan have raised funds through financial bank system. Banks have substantially monitored the management of companies, which is different from the business environment in US, where companies depend on direct financing from markets. Thereby, Japanese companies have not been asked to proactively deal with disclosure of business information. The second factor is the issue arising from requirement of multiple accounting systems. The implementation of accounting system is based on the commercial code, the security and exchange law, and the tax law. The system is very unique compared to other countries. Most companies have to prepare multiple financial reports that not only do companies exactly have to burden excessive administration, but also shareholders have hard time in understanding those similar but different disclosure.
Now let's talking about the voluntary adoption of IFRS by public companies. Since 2010, companies in Japan have been permitted to use IFRS as designated by the Financial Service Agency of Japan in their consolidated financial statements. in lieu of Japanese GAAP, as the Financial Service Agency has designated IFRS as issued by the IASB before the effective date without an exception. The designated IFRS are identical IFRS as issued by the IASB. On previous Japanese accounting standard, asset evaluation methods mainly based on the value of the assets acquired when price per view, and the importance IFRS fair value. Fair in IFRS and value is defined as generalized DCF value, but in the specific assignment of the assets, there are many assets cannot be assigned by DCF methods. Now let's talking about an example of a Japanese company Fujitsu voluntarily adopt IFRS. Fujitsu Limited announced that at April 30, 2014 meeting of the Board of Directors, it was resolved that the Fujitsu Group will switch from Japanese accounting standard and voluntarily adopt IFRS for its consolidated financial result beginning in fiscal 2014. Talking about development of the convergence between Japanese GAAP and IFRS, the big advance towards reform came in 2007 with the signing of the Tokyo Agreement, in which the ASBJ and the IASB agreed to accelerate the convergence between IFRS and Japanese GAAP. The biggest influence on Japan's accounting system has been what happened to the standards in the US. Because many of its biggest companies are listed in the US and report in US GAAP, they have watched what has happened in effort to converging US GAAP with IFRS. Well, the convergence between Japanese GAAP and IFRS program in June 2009, the BAC published the opinion on the application of international financial reporting standards in Japan, and the option application of IFRS should be allowed for consolidated financial statement of certain listed companies from the fiscal years ending in March 2010. In June 2011, the IASB and the ASBJ jointly announced their achievement under the Tokyo Agreement and their plans for closer cooperation. Both boards also expressed their intention to continue a close relationship to seek further convergence between IFRS and Japanese GAAP.
Okay, now let's talk about the corporate governance structure. The Amendment on Company Act provides more flexibility to design the corporate governance structure in Japan, but normally the stock companies should have directors, board of directors, audit and supervisory boards, audit and supervisory board members, committees, which is audit committees, external auditors, and accounting advisors. Here you can see a table of corporate governance structure in Japan. A company that is a large company and its share transfer is not restricted should have board of director, audit and supervisory board, audit committee, and external directors. But those large companies which their share transfer is not restricted, or those companies which are not large but their share transfer is restricted, or they are not large and share transfer is not restricted, they all should have board of director, audit supervisory board or board member and audit committee, and external auditors. So the difference in here is board of members. Now we are going to talk about the audit part of corporate governance structure. Audit and supervisory board members fulfill an indispensable role in the corporate governance. No current director or employee of a company or its subsidiary may be the audit and supervisory board members of the same company. Each member is independently required to examine directors' behavior and activities. Audit and supervisory board members assume the responsibility for monitoring external auditors in Japan. The Companies Act requires external auditors and audit supervisory board members to maintain a close relationship in the conduct of an audit. About the audit committee, the unique part is it's required by Japanese Companies Act for a large company. The large company means a capital of 500 million yen or more, or total liabilities of 20 billion yen or more. External auditors. Accounting auditors must be a CPA or audit, and it's required for a large company if it does not have an audit committee within the organization. But although it's required for a large company, only some 0.5% of all stock companies in Japan are required by law to have their financial statements audited by a CPA, which is different than US and is a unique point about the audit part. Disclosure requirements under the Companies Act. Under the FIEA and both the Companies Acts, stock companies are regulated and they are required to provide a business report and the following financial statements for auditing. The financial statements are balance sheet, income statement, statement of changes in net assets, notes to non-consolidated financial statements, and supplementary schedules. Now we are going to talk about the important part of due dates and timetables for both disclosure and auditing. In Japan, public companies are required to submit security reports annually and financial statements quarterly. The security reports, including financial statements audited by CPA to FSA, should be submitted within 3 months after the end of the fiscal year. Also, the public companies are required to submit quarterly reports, including financial statements reviewed by CPAs, to the FSA within 45 days after the end of the period. Regarding the timetable for auditing financial statements, in Japan, all company directors must submit the financial statements to both the audit and supervisory board and the external auditors. Within 4 weeks after the date of receiving the financial statements, or within 1 week after the date of receiving the supplementary schedules, the external auditors are required to submit their external auditor reports to the company auditors or to the directors. Within 1 week after the date of receiving the external auditor reports, the audit and supervisory board members must submit their report to the directors and the external auditors.
Now, let's talk about the unique Japanese business system called Keiretsu. It is a set of companies with interlocking business relationships and shareholders. This system and market structure has maintained dominance over the Japanese economy for the last half of the 20th century, and even today, those giant Keiretsu groups, such as Mitsubishi and Mitsui, heavily influence Japanese market. As to explain the mechanism, member companies own small portions of shares in each group members, often centered on the core bank of its own group. This system protects member businesses from takeover attempts and reduces the impact of the fluctuation of the stock market. It also prevents shortage of cash, as member bank provides low or no interest loans to the member businesses. Japanese financial reporting structure has been influenced by Keiretsu as well. Compared to the US business system, very few numbers of individual shareholders are involved. While US GAAP requires full disclosure to respond to the diverse needs of those external investors, details and assurance may not be so important for Keiretsu companies because they are basically circulating money amongst the group, the Keiretsu. Besides the other group organizations, government is another large stakeholder group. Because those two primary users commonly seek financial information for taxes, Japanese reporting system requires disclosure for tax reasons. Because of the dominance by the unique business structure and needs, external audit has been under development. However, more companies are turning to global from Keiretsu. In order to adapt the U.S. business system and audit customs, 3 of the Big Four Japanese audit firms, or Kansa Holding, maintain partnerships with the U.S. Big Four. As you can see on the left above table, Deloitte has been operating as a single firm across the countries since the merger with Japanese audit firm Tomatsu in 1975. Circle-shaped graph indicates Azusa, Shin-Nihon, and Tomatsu hold the majority of audit shares. Now you may have a question why Arata holds way small number of clients than other big firms. It is due to the accounting scandal caused by the former Big Four called Chuo Aoyama. The firm had a partnership with PwC, and its clients include such as Toyota Motors and Sony before the scandal. After the bankruptcy of Chuo Aoyama, PwC immediately created a partnership with Arata in 2006. However, it was very difficult to retrieve all the clients from Chuo Aoyama. I will explain the scandal in the next slide. Lastly, we will briefly introduce the several financial fraud cases occurred in the middle 90s up to 2014. In 1997, Yamauchi Securities filed for bankruptcy after reporting about 2.5 billion in losses. In order to hide its losses, the 100-year-old brokerage firm had engaged in a practice known as tobashi, which literally means to fly, in which Yamauchi passed off its clients' unprofitable portfolios to paper companies. In May 2006, Chuo Aoyama Kansa Holding was alleged for boosting operating income of Japanese cosmetics giant Kanebo over 6 years, up to $1 billion. The accountants were suspended prison terms up to 18 months after the judge deemed them to have played a passive role in the crime. Notably, the suspension was the first ever imposed on a major accounting firm in the country. PwC acted quickly to stem any possible client attrition as a result of the scandal and set up PwC Arata. It is said that this scandal has similarities in the circumstances in Enron case, in which Arthur and Anderson was held liable for the client's fraudulent activities. As ongoing matter, Olympus was entangled in one of Japan's largest accounting scandals, which came to light in October 2011. That was when the chief executive, Michael Woodford, turned whistleblower and revealed investment losses in which had been hidden for many years. Those banks that invested for the company recently sued for compensation of over $248 million. Thank you for watching this YouTube video, and we would appreciate your group evaluation